At this point, I think we all assume AI is a bubble and we're waiting for it to pop. But I've found a new perspective that I want to share because if it's right, it changes everything about where the markets are headed in the next 10 years. And this just reinforces the idea that we have no idea what the future holds. It could go either way, and that's what I want to explain. I think this perspective is pretty dang clever, and it comes from a guy you might not have ever heard of. His name is Gavin Baker, and he runs a firm that manages billions of dollars. And his thesis on AI's growth trajectory is basically the opposite of what every headline is screaming at us right now. So, you've probably noticed all the money pouring into AI. In fact, my brain connected the dots recently that NVIDIA's valuation alone has grown higher than the GDP of India, higher than the UK, and higher than Japan. If NVIDIA were a country, it would be the #4 highest GDP in the world. Given that, how do you not look at the stock market as a balloon that's ready to burst? Well, Gavin Baker is considering two things at the core of his unique perspective: watts and wafers. His argument is that an AI bubble might actually be physically impossible if AI can't actually scale fast enough to become a bubble in the first place. And we might immediately think that AI is scaling fast. It has been. And of course, there's Warren Buffett saying that he can't find any companies anymore that are a good enough deal to put his money into. But little does everyone know, AI might be scaling a lot slower than it could be. And while people like NVIDIA's CEO, Jensen Huang, would want to speed that up, they really might not be able to. Before I get into Baker's thesis, let me give you the bear case, because it's not crazy. Smart people are on both sides of this. Goldman Sachs has been one of the loudest skeptics. Their argument goes like this: the tech industry is on track to spend somewhere around $1 trillion on AI infrastructure over the next few years alone. The hyperscalers, Microsoft, Amazon, Google, and Meta, they're all pouring money into data centers and GPUs at a pace we've never seen. And Goldman's question is simple. The input is obvious. Where's the revenue? Where's the output? Sequoia Capital made a similar argument. They estimated that the AI industry would need to generate about $600 billion in revenue just to justify the infrastructure spend that's already been committed. They call it a question the industry has to answer, and not in 5 years, but soon. And if you just look at the patterns, massive capital flowing into a hot new technology, stock prices running on hype, valuations that are disconnected from current revenue, it looks exactly like a bubble. But here's where Gavin Baker comes in, and what he says reframes this entire conversation. It's a single observation, really, that in every previous tech bubble, the thing that crashed the market was oversupply. The dot-com era is one example. Telecom companies laid millions of miles of fiber optic cable, and at its peak in 2000, roughly 99% of their work was unused. They overbuilt so massively that it took a decade to absorb that capacity. The argument here is that the bubble popped because supply got totally disconnected from demand. Then there's the railroad boom of the 1800s, which had investors pouring absurd amounts of capital into laying down track. And everybody wanted their own rail line. Companies would issue mountains of debt to build competing routes to the same cities. And at the peak of all of that, much of the track also sat unused. Then the bubble popped, bankruptcies flooded through the system, shareholders got wiped out, but the railroads that survived did permanently transform the global economy. It just took decades, but the infrastructure was real and helpful, and the markets grew higher than ever before. It was just after the crash. So these bubbles weren't about tech being fake. The tech was changing the world. The bubble was about supply racing so far ahead of demand that the math broke. There are several more examples of this throughout history that I encourage you to go look up. It's a wonderful observation from Baker and a great way to better understand bubbles and the market. And his thesis, which he calls Watts and Wafers, is that these examples are not being repeated today because they can't be. The physics of manufacturing make oversupply structurally impossible. At least that's what he says. On one hand, saying that this time is different does sound like famous last words. But on another hand, I see Baker's logic, and if there's even a 1% chance his narrative is right, I think it's worth being aware of. So let's start with Wafers. But first, 10 seconds of your time. Hi, I'm Cam, a licensed financial advisor, and each week on this channel, I try to learn more about finance, productivity tips, or news that you actually need to know, all to help you earn more and do more in your life. Please like and subscribe as the best way to currently support this channel. Okay, so Wafers. Every advanced AI chip in the world is made by one company, TSMC. That's Taiwan Semiconductor. And TSMC is not a normal company. Baker describes their leadership as, and I love this description, flinty old men and women in their 70s who have one overriding priority: never ever let a bubble form. These are people who've been around long enough to have survived previous semiconductor crashes. They watched competitors overbuild and go bankrupt. They see themselves as custodians of Taiwan's economic security. So if a tech bubble popped on their watch, it would be catastrophic for their entire country, and they actively don't want that. So what do? They intentionally bottleneck the industry, only expanding capacity in tiny, measured increments. Low single digits per quarter, 5% here, 3% there, keeping the entire world perpetually in a state of chip scarcity because they believe that's how you prevent a crash. It's fascinating. Here's what's crazy and backs that up. Apparently, Jensen Huang flies to Taiwan every 3 months to beg for more capacity. And projections do suggest that if TSMC said yes to him, if they just opened the taps, NVIDIA could sell maybe $1.5 to $2 trillion worth of GPUs in a single year. That's how much they could be building right now. But TSMC won't do it. And here's why they can get away with that decision. There's literally no one else on planet Earth who does what they do. The machines that make these chips at TSMC come from a single company called ASML. They're based in the Netherlands. They have a global monopoly on extreme ultraviolet lithography, and each machine costs roughly $400 million, where a critical component within those machines come from a single specialized team in Norway. So if you wanted to place an order today for a machine, you'd probably be waiting 5 years to get your delivery. That's how deep the backlog is. To sum all of that up, the supply chain that companies like NVIDIA wants more access to bottlenecks at TSMC, and TSMC's supply chain bottlenecks at ASML, and ASML's bottlenecks at a team in Norway. That's what's going on with the wafers. Now let me talk about the watts. AI data centers consume huge amounts of power. And as the GPU count scales up from tens of thousands of GPUs to hundreds of thousands to train and run AI, the limiting factor stops being, can I buy these chips? And becomes, can I get enough electricity to run these chips? Our power grids were not built for this. You can't just call up the local utility company and say, hey, I need a gigawatt for my new data center. We have aging infrastructure, and that's another wall that we're running into. Industry projections suggest this power shortage will constrain AI scaling until at least next year or 2028. And in the meantime, this is the part that feels a little bit like science fiction, but is actually happening. The AI industry is literally going to space. SpaceX is developing orbital compute. Orbital compute? I should have looked up how to pronounce that. What that means is data centers in orbit. And apparently they're doing this because solar panels get 5 to 8 times more sun up there than they do down on Earth, continuously. No nighttime, no clouds. And since space is pretty cold, cooling these hot GPUs becomes far easier as well. Because of Starship's reusability, the cost to take GPUs to space has shrunk down. And people are already projecting that orbital computing will handle the bulk of AI workloads by the end of the decade. That's wild. So back to the bottlenecks, TSMC being conservative, ASML having a backlog and the limitations of our power grid. We have Elon Musk, Tesla, and Intel collaborating on something called Terafab to build the world's largest chip factory in the United States. And it won't be done overnight. And I think that exactly what Baker's saying is becoming clearer to me, that we're seeing something similar to the dot-com era and to the railroad era, but potentially without a bubble. A foundation of a much bigger future economy being built, however far in the future that is. And also, I think that we're getting the biggest opportunity maybe ever for the greatest human connection, or for the greatest human disconnection that we've ever seen. Optimistically, I think that's up to us. But the takeaway here from Baker's thesis is that we have real constraints keeping AI supply from outrunning demand. And today, basically every GPU manufactured is operating near 100% utilization. But there is one more piece to this story, and that's the money. In the dot-com era, the build-out was financed by debt, high-yield bonds. There came a point when companies couldn't pay, and it all collapsed. The AI build-out is being funded almost entirely out of operating cash flow. Microsoft, Alphabet, Meta, and Amazon These are all companies generating tens of billions in free cash flow every quarter. I mean, their balance sheets are like fortresses. And even if AI revenue materializes slower than expected, the argument is that there's no existential solvency risk. No debt bomb waiting to detonate on us. Anthropic, the company behind Claude, added an estimated $11 billion in annualized recurring revenue in March and April of 2025 alone. By early 2026, Anthropic's annualized revenue approached $45 billion. And analytical models suggest that if GPU supply weren't constrained, if the Watson Wafers bottleneck didn't exist, Anthropic could be generating somewhere between 100 and 150 billion in annualized revenue right now. But there is a bottleneck and it slows everything down. And that might be a great thing because, as Baker says, the last thing anyone should want is a bubble. And this is speculation and not at all financial advice. But at a rumored private market valuation of around 900 billion for Anthropic, that implies an unconstrained price to revenue multiple of 6 to 9x, whereas traditional software companies often trade at 15 to 20x. So if Anthropic's true demand is anywhere near what the models suggest, then it might not be overvalued. It might be dramatically undervalued. But even then, that doesn't change the fact that in Warren Buffett's eyes, the whole market is at least not undervalued. He's not finding any deals at the moment. And you're left wondering if you should side with Buffett's mentor, Benjamin Graham, who says in his book, The Intelligent Investor, that there will always be a catastrophic collapse as a normal part of market volatility. Or do you side with Baker, that this is a unique moment, and while we might have volatility and corrections, he is betting that there won't be a massive crash. Me, I think the bubble question might be the wrong question. And the right one would be, what is actually scarce? In every gold rush, the suppliers are well positioned to profit. That's people who are selling the picks and other mining supplies, not the actual people digging. And they're well positioned to profit regardless of whether or not their consumers strike gold. In this AI supercycle, the picks and shovels are the Watson Wafers. And there is a structural physical limit on how many can be produced. But the producers are making real money, selling real product, in a market where there's currently more demand than supply. That doesn't mean every AI stock is a good investment right now, and it doesn't mean that we're protected from a market crash happening tomorrow. Baker's thesis could be dead wrong, or it could be mostly right, but we still see quite a bit of big volatility. This is what's hard about knowing what will happen tomorrow. This is what makes it impossible. It's that you can look at the same data everyone else has looked at, the spending, the valuations, the hype, and the effect that AI is having on all the other companies in the markets, and conclude that none of those things matter as much as a factory in Taiwan that expands capacity 3 to 5% a quarter, and a machine in the Netherlands that takes 5 years to deliver. I'm Cam, licensed financial advisor, not your financial advisor, still figuring out what this channel's going to be, but I know it's going to involve more stories like this one. So hit subscribe for more educational and entertaining content. I'll have a new video up next Friday. See you then.